Hello, welcome to my channel. If you are a non-finance background professional like me, you come to the right channel. I'm going to share with you all about corporate finance stuff I got from the guru himself, Professor Roy Sembel. He delivered one of the exciting courses in the Executive MBA program of IPMI International Business School. Let me start with the key benefits I got from the course, particularly for a non-finance guy like me. I'm now able to understand and explain key financial management decisions made by my business and finance peers and the interlinkages among them. I can explore now and evaluate opportunities in order to create financial value to the firms as well as to the investors, and to comprehend and discuss in a structured way hot issues that emerge in the business and finance media.
These are the topics of corporate finance covered in the course. I will use a mind map format. It's easier to explain and followed in a systematic fashion. Let's start with financial management. Financial management is the optimal orchestration of internal and external financial resources. All resources translated into financial resources with the objective towards significant and sustainable value creation. What to manage? Capital structure. Debt versus equity, which one we should use for the financing? Working capital management. Working capital is about day-to-day finance. Current asset is what we use day by day, and then choice of working capital financing, whether you use the financing based on the short-term or long-term financing. Asset structure, the fixed asset versus other asset. Revenue management, whether we have recurring revenue or one-time revenue and one portion of recurring revenue. Cost management, fixed cost portion versus variable cost and how to make it efficient. Cash flow management, there are 5 principles of cash management. Growth management, whether we use only the organic growth or we combine organic and the partnership, merger, acquisition, etc. Risk management, managing the risk appetite and then managing the overall risk of the company. What's the goal of the firm? It's the significant and sustainable value creations. We learn about the principal agent problem. There are 3 major components. First, conflict of interest between two parties. The principal in this case is the shareholder, and the agent is the management. They have different interests. Second is moral hazards, meaning that everyone tends to work for their own interests. The owner wants to get the best value creations for the company and then order the management to do that. However, the management has different interests. The interest of the management is to get high compensation, high bonus, and work lightly and relax. That's very human, but that can create problems. Two different interests. The agent has a tendency not to work according to the order of the principal because the agent serves their own interests. Third is information asymmetry. It's difficult to distinguish whether the agent already worked according to the order of the principal because of the information asymmetry. Meaning that the agent, that is the management, knows day-to-day stuff about the company. All the information about the company day-to-day is on the hand of the management, while the owner, the shareholder, only get the report, maybe quarterly report. For example, in the public listed company, they are asked to publish the company financial report to public every quarterly or maybe once a year during the annual general shareholder meeting. So the principal knows less about the company, the agent knows more about the company. That creates a problem. The agent may report only the good things about the company. They can manipulate even the report, and then the principal, since the information is limited, they are at a disadvantaged position. If it's going on like this, then it's not good and not healthy for the company. The solution of the principal-agent problem should be a comprehensive solution from micro, meso, and macro perspective. For example, we can control the quality of employees starting from the recruitment, development process and operate with delegated authorities. And regulators require good corporate governance. Cannot be 100% effective, but may reduce the probability of the principal-agent problem to be a significant problem. So the good corporate governance is part of the overall solutions from macro perspective. Briefly about the good corporate governance. It's the governance from the top level, like the BOC, annual general shareholders meeting, that's the governance. While the management is from the BOD below. Very clear separations between governance and the management. Having good governance from the top. You combine the good governance and the good management to solve the principal agent problem. That's the comprehensive solution. And also, if it's a public listed company, you'll be helped by the external parties, for example, the analysts. All the public shareholders will help you to monitor the company. That's external monitoring. There is internal monitoring, and then the transition between the internal monitoring and the external monitoring. That's the benefit of being a public listed company, because not only you, the owner, will monitor the company, but the regulator will monitor the company, the analysts, the media, the public will monitor the company. That will reduce the potential problems of the principal agent's problem. The principle of DCG is transparency, accountability, responsibility, independency, and fairness. Or we can call it tariff.
We then learn about the principle of value creations, which are basically the things we need to see for value creations. We use McKinsey four cornerstones or pillars of corporate finance, which they formulate from the experience they got during the dot-com bubble in 1999 and 2000. The first pillar is about the core of value principle. The value is driven by the three things that is return on capital, growth, and cash flow. So when we want to create financial value, make sure we produce these three things as the indicator. Return on capital, kind of profitability measurement, and then growth. If you don't grow, you don't create value. You have to prove that at the end of our activity, we produce the real net cash flow. So cash flow should be one of the indicators, not only the profitability or even EBITDA. EBITDA is between cash flow and profitability, but not the real cash flow. The second pillar said that despite so many things and publication we do for our company, but do not touch the three things, we don't actually create value. Only move the value from the left pocket to the right pocket, from our pocket to other people's pocket. No value creation if you don't touch that three things: return on capital, growth, and cash flow. And in the capital market, why there is a bubble and a burst? Because it's about expectation treadmill principle. It means the synchronization between fundamental and perception. If the perception is too over optimistic, then it becomes bubble. If otherwise over pessimism, it's burst and the price drops significantly. So supposedly, as the company top management, our responsibility is to align the information about our company fundamental internally with how well we manage the company according to those three things: return on capital, growth, and cash flow. We have to communicate it well with the stakeholders so that there will be harmonizations between external expectation than the actual fundamental. That's the expectation treatment. And then another important thing is to create value is that we have to check the asset under our ownership, the asset in our balance sheet, whether we can create the best value out of that asset. If someone else can create more value out of the same asset, then we are not the best owner of the asset. Someone else is the best owner of the asset. So what are you going to do with that situation? Well, we can sell the asset to someone else that can create more value out of the asset. Or if we cannot sell it, we can collaborate with that somebody. That's the best owner principle.
According to Ramcharan, a professor, entrepreneur, and consultant, there are five things for the value creations. The five principles of value creations. The four things from Ramcharan is the three things according to McKinsey. Return on capital is the multiplications of profit margin and velocity. Ramcharan add one more about the non-finance thing, that is the source of money is from our customers. So we have to focus on our customers. One important area in corporate finance I see is the capital budgeting.
Capital budgeting is one of the examples of the application of the time value of money. What is the time value of money? It's basically the decrease of money value over a period of time. We may not be able to buy the same stuff today in the future with the same nominal of money. That is the purchasing power of money decrease. That is the decrease from today to the future is the opportunity cost of money. The increase from present value to the future is called compounding. The decrease from future value to present is called discounting. We learn also about the rule of 72. It's a simple way to determine how many years an investment will double by dividing 72 with the annual compounding fixed interest rate. So basically, capital budgeting is the planning process for investment in the long-term asset. By estimating the projected cash flow with some criteria, we can evaluate and determine which investment projects will bring more value than the other, and then decide which to accept and which to reject. After we estimate the cash flow, the easy method to calculate is the payback period. How many years does it take to cover the initial investment? We will select the project with the payback period as defined by the business requirement, below which is the project we accept. However, there are weaknesses of this payback period method. It's subjective. How can we tell 3 or 4 years payback period is good? It's not considering time value of money. It's not considering the required rate of return. It's not considering all the cash flow of the project. It's not calculating the cash flow of the project. There are three other methods that can address the weaknesses of the payback period method, which are the net present value, probability index, and the internal rate of return. NPV is the comparison between the benefit of the project they will receive in the future in terms of the cash flow present value compared to what we have to sacrifice today. So if what we expect to get in the future is more than what we have to sacrifice today, then it's a good project, creating value. Because the net present value is positive, then it means it's good. For capital budgeting, positive is good for NPV, meaning that the benefit is higher than the cost. Supposedly, there are two projects with positive NPV. They are independent projects. We can accept both. But if it's mutually exclusive, then we choose the one with the higher NPV. That time value of money application to NPV. Next, profitability index. It's the ratio of all the cash flow present value, which are the benefits in the future, and divided with the cost. If the result is more than 1, the benefit is higher than the cost. It's good, and we can accept the project. For NPV, it should be positive. And for profitability index, it should be higher than 1 because it's ratio. The third method is IRR. The IRR is the average percentage return per period that we get from the project. If we put money in the bank, the IRR are equal to the interest rate of the bank. The equivalent number of the return for the project we have to calculate using some formula of IRR. The percentage average return for our investment in the project. The decision rule, if the IRR more than the target return in percentage, which is usually higher than the time deposit, then we accept. Fraud risk management. In the class, we learn about financial shenanigans. It's the actions or omissions designed to hide or distort the real financial performance or financial conditions of a company. The 7 modes of shenanigans: recording revenue too soon, recording bogus revenues, boosting income with one-time gains, shifting the current expenses to a later or earlier period, failing to disclose all liabilities, shifting current income to a later period, shifting future expenses into the current period. There is a model to explain the motives of shenanigans. It's the fraud triangle. One is the perceived pressure, comes from financial pressure or the work pressure. Second motive is the perceived opportunity, comes from the weak internal control or the ineffective monitoring of controls. Third comes from the rationalizations. It's the justifications for the bad action. To minimize the pressure or rationalization, there are 4 types of incentives. One is physical, second is monetary, third one is social, fourth is moral. So for the fraud preventions. Build employee ethics. Write SOPs that have to be followed if fraud event is suspected. Train employees to increase alternatives for fraud and how to prevent fraud, including financial control procedures, IT securities, etc. Protective security using hardware and software. Create whistleblower mechanism. Whistleblowing is the act of reporting misconduct to managers, executive, or other authorities with the power to take corrective actions. It's a kind of tool to empower employees to identify wrongdoing and to protect the integrity of the organization. We have a good discussions on the class of which conduct can be regarded as unethical or illegal. And the discussions on greed, is it greed? It's good. If it means ambition, it's good. Another interesting topic in corporate finance is investment strategy. Fundamental analysis basically combines the quantitative approach, which is all the macro indicators, all the numbers like the GDP, inflation, interest rates, how that macro variable will affect our company and then the industry. Part of the fundamental analysis will calculate the intrinsic value based on our knowledge of the company, from the macroeconomic perspective, from the industry, from the company performance, and the projection, and use the discounted future cash flow for the company or the investors. If the market price is too high compared to intrinsic value, means it's expensive. We sell. If the market price low is cheap, we buy. If the market price is more or less the same as the intrinsic value, then it's fair price. We hold. This method is applied by Warren Buffett, the greatest famous global investor. He uses fundamental analysis. Warren Buffett tenets are business tenets. You have to know the business inside out in order to understand the source of value creations, the cash flow, and the management. By management tenets, you check the good corporate governance of the management if the management's already tried to overcome the principal agent's problem. By financial tenets, you analyze the financial reports over several periods. And market tenets, you calculate the intrinsic value and compare it with the market price. In the financial statement analysis, we learned that there are 2 major questions that will be asked by the shareholders or the investors. The first is, what happened to my equity balance? Is it increasing or decreasing? That is the profit, which is the additional balance of the equity. The second is how much dividend they can draw from the profit. It depends on the cash that is available. So basically, income statement is about the change of equity balance, and cash flow statement is the change of the cash balance. So those are the interlink between balance sheet, income statement, and cash flow statement to answer the two major questions of the investor. There's the profit, which is the additional balance of the equity, and how much dividend they can draw from the profits. Depends on the cash that is available. The cash balance is different from equity balance. So net profit is not the same as net cash. Now, how to identify companies healthy or not healthy? There are four ratios for non-public listed company and the fifth ratio for public listed company. We calculate the ratio basically measuring the risk and return, profitability, liquidity, activity, leverage, and market ratio. Then we have to check the benchmark. The natural level is the current ratio above 1, or the quality of the number, historical trend, is it getting better or worse? The industry benchmark, is it above or below the average? Then for the investor, the important thing is the ROE. We can break down the ROE using the Pong analysis to be net profit margin, return on asset, and financial leverage, and analyze further to identify areas of improvements for the company. Technical analysis is about analyzing the historical patterns of graph, price graph and volume graph, mostly price graph. Then after we analyze the historical pattern, then we can find the repeated pattern which can be up, down, or stay the same. There are thousands of methods for technical analysis, but only about 10 are commonly used, such as trends, momentum, support and resistance, double bottom, double top, gap, etc. We learn about portfolio theory, which basically tells us how to combine stocks in a portfolio to get the optimized risk and return, and apply it in the stock portfolio simulations group exercise. There are three types of return: the predicted return or potential future return, the historical return, which is what already happened. It can be the data from the past 3 years biweekly. The required return, the benchmark to determine whether what will happen is good based on what has happened is good. There are three types of risk. Total risk, which is represented by the variance of the return. Inside total risk, there is unsystematic and systematic risk. The unsystematic risk is the volatility from company-specific news. For example, if the company one building there's fire, it's different from company to company. Systematic risk is the macroeconomic risk, the interest rate increase. All companies will experience this. The one that we can erase by combining stock in the portfolio is the unsystematic risk. One company can have bad news, but the other can have good news, so it cancels out. The benefit of the diversification, if you combine several companies in one portfolio, you can reduce the risk by canceling one bad news with the other company good news. In order to get the maximum benefit of diversifications inside our portfolio, we may want to choose the stock of the company that have very low correlations, or the statistical term is co-movement. If the co-movement tends to be positive, meaning if one company's stock price increases, the other company tends to increase. There will be minimal benefit of diversifications because the movement is the same. But if the movement is different, if one company drops, the other company go up, then it can cancel out the movement. So that's the very low correlations, mean the movement will not be the same, no co-movement. To get the benefit of diversifications, do not put your egg in one basket. You create a portfolio to get the maximum benefit. Find companies that have low correlations or low co-movement. To get the optimal or very required return, we use capital asset pricing model, which is based on portfolio theory. That if you combine two portfolio of assets, we want to get the highest return with the lowest return, with the lowest risk. But not possible because the most optimized risk profile or combination of risk and return will lie within area near the efficient frontier. So according to capital asset pricing model, the required return, the fair return is based on the logic. If you have high risk, then you're entitled to get high returns. High risk, high return, low risk, low return. Compensation for sacrificing your consumption is the risk-free rate. The higher risk, the higher required return. It is called risk premium. Risk premium is the return on top of risk-free rate that you're entitled to get when you carry some risk. The risk-free rate approximation is, you can use the ORI. Yeah. If you carry some risk, you have to add extra return on top of the risk-free rate, called the risk premium. High risk, high gain. How much extra return you will get? The first benchmark will be the overall market. The market has some risk. The market gives the average return. This is called the market risk premium. However, your stock risk can be higher or lower than the market. There is a multiplier. When your risk is higher, then the market multiplier is higher than 1. The lower your risk than the multiplier is lower than 1. If your risk is equal to the market, the multiplier is equal to 1. It's called beta. It captures the logic of risk return. The formula of CAPM is you start with risk-free rate and you add market risk premium with multiplier of beta. Next is the capital structure. Capital is the long-term sources of fund, which is long-term debt and shareholders' equity and other instruments that have long-term maturity. Capital structure is the composition of the long-term sources of fund, consists of long-term debt and shareholder equity. What is the ideal composition of debt and equity? In order to answer these questions, we have to look at the value of the firm, which is the present value of future cash flow for capital holders, consists of the debt holders and the shareholder. Then if we increase the debt ratio, what happens to the value of the firm, the future cash flow? The answer refers to the Modigliani and Miller theory, the irrelevance of capital structure. The theory says that if all factors are ideal, then it's irrelevant. But if we change one factor not being ideal, then we can see that the impact on the firm value. For example, the tax. The higher debt, the higher will be interest rate. The lower will be the earnings before tax, the lower the tax. The higher the debt ratio, the higher the value of the company. It's the tax shield of interest payment. However, if you keep increasing the debt ratio and reach 100%, the suppliers might not be comfortable. They worry, unable to pay the order. Customers not comfortable of the service quality. Employee will not be comfortable. If something happens, the future of the company in jeopardy. So your bid will shrink. The expected cost of financial distress is increasing. The value of the company decrease. So up to some point, that ratio increase is good for the company because of the tax benefit. But beyond that point, then the financial distress cost will kick in and reduce the value of company. The higher the debt ratio, the higher the financial distress cost. The stakeholders start to worry and start to reduce business with you. Optimal debt ratio depends on the company situations. No one size fits all. It depends on the tax benefit. Can the company get the tax benefit or not? If the company can get the tax benefit, the higher the tax factor, the higher the optimal debt ratio. The measurable and observable indicators of the company that will need more tax benefit is look at the profitability. The more profitable, the more required tax shield. The second is look at the expected cost of financial distress. How easy the stakeholder to be worried about the company's future? Do they have stable cash flow, good market conditions? How's the industry specific? Is it heavy equipment company will have higher fixed asset, so they would have higher debt ratio. Then we learn how to do corporate restructuring. Companies need corporate restructuring if they show symptoms of financial distress, like early impairment or deteriorations of performance, cash flow problems, failure to pay the suppliers, default payment to the bank, or insolvency which leads to bankruptcy. Outcome of the financial distress, if it is a permanent problem, could be private liquidation or file for legal bankruptcy. If it's not permanent, there's a turnaround opportunity. So the outcome could be operations restructuring or asset restructuring by selling and leasing back, or financial restructuring. Have to negotiate with the creditors. If it's one-on-one, it would be a private workout. If it's collective, it could be filed for legal bankruptcy through the court. Or in Indonesia, we call it penundaan kewajiban pembayaran utang or PKPU. To save the company in financial distress in order to survive and transform the business. Change the management. Stop the bleeding or the cash flow. Do financial restructuring. Do temporary pivoting by finding any ways to increase the revenue and the profitability. Do strategy realigning. Redefine the core business. Find new ways of doing business. For the strategy, we can check all the business units of a company. Is it profitable or not? By using the Boston Consulting Group Product Portfolio Matrix or GE McKinsey 9-cell matrix. The BCG matrix plots a company offerings in a four-square matrix with the y-axis representing the rate of market growth and the x-axis representing market share. The four boxes representing the dogs, which is the SBUs, the company division, the product line, or even an individual brands with low share or of low growth market. It doesn't generate cash for the company and tends to absorb it. So get rid of them. The cash cow, it's the SBUs with the high share of slow growth market generate more than it's invested in them. So keep them in your portfolio for the time being. The question marks or problem children. This is the SBUs with low share of high growth market and consume resources and generate little in return and absorb most of the money as you attempt to increase the market share. We have to check their market attractiveness. And the stars. This is the SBU with high growth markets with relatively high share of that market. It tends to generate high amounts of income. Keep and build our stars. So try not to have any dogs. Cash cow, problem children, and stars need to be kept in a kind of equilibrium. Funds generated by cash flow is used to turn problem children into stars. They eventually become cash cows. Some of problem children will become dogs. We'll need larger contribution from the successful products to compensate for the failures. With GE McKinsey 9-cell matrix, we use the 9-box matrix to plot the business units on its 9 cells. The BUs are evaluated on 2 axes, industry attractiveness and the competitive strength of a unit. The result will indicate whether the company should invest in the product, harvest or divest it, or do further research on the product and invest in it if there are still some resources left. Leverage buyout can be simply explained by answering the questions of who's buying what from whom using whose money. We discuss and try to understand LBO concept with the case study of RDR Nabisco. Next, what is the source of value creation? It's the reductions of the conglomerate discount. Second is the increase of that ratio toward optimal value to get the tax benefit or tax shield, while the cost of financial distress is still low. This is possible as the cash flow is strong and stable, and would reduce principal agent problems from too much of free cash flow. On dividend policy, why the public listed companies still need to pay dividends, even though the investors can get money from the capital gain, and then they can always realize the gain by buying and selling in the capital markets. First, one important factor is tax. Not relevant to the corporate tax, but relevant to the investor tax rate. For example, the major shareholder of the company, they can get money through dividend without paying taxes. Second one is the principal agent's problems of too much cash flow. One way to force the company to get out the cash from the too much cash flow is by paying dividend. The next thing is the shareholder expectations. You can create value through the capital market by paying dividend consistently. If you can pay dividend, and it shows that you are confident about the future of your companies. Now let me share about the efficient market hypothesis. This reflects all available information. Thus, financial asset prices are fair prices. They are neither too high nor too low. What do we mean by all available information? It's the historical trading data, the publicly available information, all private and public information. There are 3 forms of efficiency. Weak form of capital market efficiency, which is current price reflects only the information contained in the past trading data, the prices, the volume, etc. Second is semi-strong form of capital market efficiency, which is the current prices reflect all publicly available information. And the third form is a strong form of capital market efficiency, which is current prices reflect all public and private information that can possibly be known to anyone. Implications of efficiency for investors. Future market prices cannot be predicted based on available information. It's random walk. Investment in these markets have a zero NPV, which is the expected rate of return equals the required rate of return. The expected rate of return compensates the investors for the risk borne. Abnormality high returns are earned by pure chance. Characteristic of perfect capital markets is there are no barriers to entry. Perfect competitions. Each participant is sufficiently small and cannot affect prices by her or his actions. Financial assets are infinitely divisible. No transaction costs. All information is fully available to every participant at no cost. No tax asymmetries. No restriction on trading. But there are some imperfections. Asymmetric taxes. This changes the zero-sum nature of capital market transactions. Asymmetric information. Information is not equally and costlessly available to all market participants. Transaction costs are generally less important, often imperfections. So it prevents markets from being perfectly efficient. So what's the strategy in an efficient market? Diversify. Select suitable asset allocation. Don't try to time security price movement. Keep tax consideration in mind. Do passive investing of index fund and dollar cost averaging. I really enjoyed the class of Professor Roy Sembel. It's really fun, and I remember his motto of it's okay to make mistakes. He successfully made the most complicated subject of corporate finance to be light and enjoyable. Thank you for staying to the end of this video. I hope the content is useful. Keep safe and stay healthy. Cheers.